Hey traders, Gavin McMaster here from Options Trading IQ, and today I'm going to show you how to potentially get a 35% return on Amazon over the next 6 months. So here's the trade setup. This is something I talked about on Investors Business Daily yesterday. If you don't know, I write a daily article there, so make sure you go and check that out each day. But basically, it's looking at a long-term bull put spread on Amazon. And this trade will make a 35% return provided Amazon stays above 165 between now and March, which has a pretty high probability in my opinion. The short strike of 165 is a 25 delta, so we can roughly say that it's got a 75% chance of expiring out of the money. Before we discuss the trade in more detail, just a reminder that everything is for educational purposes only, is general in nature and does not take into account your personal circumstances. So looking at the trade, we've got a 5-point wide bull put spread. We've got 5 contracts here, and that's generating about $650 in premium. If we want to calculate the capital at risk on the trade or the maximum loss, we can see it here on the risk graph, which is about 1,850. We can easily calculate that in Excel as well. I'll just show you just quickly how to do the numbers. Hopefully this is pretty straightforward for most of you, but we've got 5 contracts times 100 shares per contract, and we're 5 points wide. So that gives us 2,500, but we've got to reduce that by the premium received. So we're doing 5 contracts. So we'll say positive cash flow, and we'll take the price that we're selling the option at minus the price of the option that we have to buy. So we're going to generate roughly $650 in premium. And then the maximum loss is the difference between the strikes times the contracts minus the premium received. So you can see there about 1845, 1850 capital at risk roughly. If we take the premium received, which is the max profit, divided by the maximum loss, that is our return potential on the trade, which is a pretty decent return. And that's in 6 months as well. So that annualized would be closer to a 70% return. Now that assumes everything goes well with the trade. Obviously, the price of Amazon could drop, which could lead to some losses in the interim or even at expiration. So what we've got here is our risk graph at expiration, the blue line, and the purple line is our T+0 line, or how does the trade look as of today. If the stock drops, we're going to lose money in the interim. If the stock rallies, we're going to make some money in the interim. And as we get towards expiration, slowly in this case, because it's quite a long-term trade, this purple line will move upwards towards that blue line. And down here below this midpoint of the spread, this purple line will start moving down towards the blue line. So we don't want to be down here. We don't want the stock to be down here and we're losing money each day through time decay. We want the stock to stay above 165, where we're going to have positive theta, and this purple line is going to be moving up, and that's going to represent our profit very slowly each day as this moves up towards the maximum profit. In terms of trade management, I would definitely look to roll the spread. And I've got some videos on rolling and lots of articles about rolling and adjusting credit spreads. But if Amazon got down here into this 170 to 175 range before we get to the short strike, I'd look to buy back this spread and roll it down to lower strikes. Potentially, depending on how the chart is looking at the time as well, I could potentially add a few contracts. Now, the other thing you could do to cut some of the risk on this trade, it's a positive delta trade. We've got positive delta of 19, delta dollars of 3,500. If we wanted to have a little bit less directional risk, we could sell a couple of call spreads on the upside, which would turn it into an unbalanced condor. And I'll show you what that would look like. So you can see I've added some calls here. I've gone with a 15 delta rather than the 25 delta that we've gone with on the puts, a slightly lower delta on the calls. And what you can do is go unbalanced as well, and maybe do, say, 3 contracts in the calls. And you can see that's so far out that it's actually not even showing on our risk graph here. So pretty low risk. It's cut our delta down from 19 to 12, and it's also generated a bit more premium. So you can see here that total profit line has now gone up to $800, and our maximum risk has actually reduced to 1,700 because we've generated some extra premium. 3 contracts times about 50 cents for that spread, generating about $150 in premium. And we've reduced our delta, we've generated more premium. So that's a nice little tweak that I'll sometimes do with my bull put spreads, is just to add some out of the money call spreads as well. So I'd love to hear what you think about this trade idea. Let me know in the comments. Longer term trades have a much lower gamma, so the P&L is going to generate much slower than shorter term trades. But you're also going to lose less if the trade moves against you as well than you would with a shorter term trade. So it's a much slower moving trade than a short term trade. I kind of like these at times because they're very much low maintenance trades. You can generally put them on and you don't have to do a lot with them for the first month or two usually, unless the stock makes a really big move to the downside. So let me know what you think. I hope you enjoyed this idea. Best of luck with your trading, and I'll talk to you soon.